What's up, guys? Welcome back to another episode of Stock Talk with David. I'm David. In this tutorial, we're discussing the options chain. So really how to read it, what to look for in the options chain, what are the main components, right? And so ideally, if you're watching this video, you probably don't have much exposure to options. So this is a really great place to learn. Again, this assumes you have a little bit of knowledge of how an option works, and now you're understanding, trying to learn what are the pricing, what are the key metrics, etc., right? So let's get into it. The very first thing I have here is SPY. This is the S&P 500 index fund. It's very, very liquid. It's traded probably the most on the stock exchange. And so it becomes a really good example for us, right? And again, I'm using TD Ameritrade. So the first thing I'm going to look at here is I'm going to pull up what most everybody sees when they first look at an options chain. And what we're going to find is that we have 18 February 22. This just means the option expires on the 18th of February. There's 23 days to expiration. The next thing we look at is the strike price. This tells us at what price of the underlying does the option expire on. So that makes sense, right? And the next thing I'm going to look at here, and again, this is moving after hours quite a bit, so it's going to make the numbers a little bit jumpy, but they'll stay about the same. And so we'll see that at the money here is about 436, give or take. And so we're getting a bid-ask spread, and we're getting a bid at 9.66, and we're getting an ask at 9.75. So this just means where you can buy it, where you can sell it. And the next thing I look at here is the delta. The delta basically measures the rate of change of the underlying. And so let's say that SPY moves up $1. I can expect to make 49 cents per dollar that the underlying moves up, meaning my option will gain 49 cents in value per every dollar that the option moves up in price, or the underlying moves up in price. The next piece is gamma. Gamma basically measures the underlying of the delta. Not as important. Theta measures time decay because as options, they all have an expiry date. As we get closer to expiration, in theory, the option becomes less valuable, right? And then Vega, which measures sensitivity to implied volatility, which is a whole other concept. But again, the most important one is really going to be delta and your theta, right? So the next piece we're going to look at here is just how does that translate to the put side? Very, very simple. Bid, ask, delta, gamma, theta, Vega, right? So whatever you do to the left side, the right side is going to have on it as well. So pretty simple there. Now the ones that I do typically look at, getting all these alerts, the ones that I typically do look at are going to be implied volatility, probability out of the money, and delta. We already discussed delta, so we'll look at probability out of the money. Because options have so many numerical inputs to them, they're constantly traded. The platforms and all brokers will give you the probability of the option expiring out of the money. And so what we can do is we can take this, we can understand what our risk is, what our expected return will be. That's something to focus on in a later video, but it's just good to know. So when I'm doing my options trades, which I don't do a ton anymore, but when I'm doing them, I will always add some element of what is my expected return on the options chain. A little bit complex, but anyway. Moving to implied volatility on an annualized basis, this is just saying how much we can expect the underlying or at least the option itself to move up or down, and how that translates to the underlying, right? So we say underlying, we're really just talking about what stock is being represented in this options chain. Now, if I go the same way through, we see that we have the same thing for the puts, implied volatility, probability out of the money, and delta, and the bid-ask spread, right? It's something that's really common, and you'll see it a lot, especially in a market like ours today, at the time of filming this video. You'll notice how for 436 on the strike price, we're getting a bid-ask spread that's much larger, or rather, the bid price, the value of the options for the puts are actually a bit higher than the calls. And I think that makes a lot of sense because right now we have a lot of people that are assuming the market's going to do pretty bad. We've got a lot of interest rate talk. We've got Ukraine crisis, all these crazy things happening in the economy. A lot of people are going into puts right now. And so in the short term, that can throw off the value of puts as well. typically there's more money in puts during times like this, so it'll really just throw off the value. So you might see that. Typically there always is, whatever reason, a lot more implied volatility loaded into the puts. As we can see, we got 31 and a third right here, and we've got 24 and a third essentially. So you can just see how the implied volatility changed. So that's not really essential to reading the options chain, but just good to know. And so that's it, guys. That's all I have for this video. If you liked this video, be sure to comment and subscribe. Add it to your saved video so you can come back again and again and keep learning from it. Hope you guys have a great rest of your week.